We've Jerome Jean Hegeli, Group Chief Economist at Swiss Re now joining in. Jerome, great to have you with us here. I hope I got the name right. Apologies if I did not. Just a quick, and thank you for being here on CNBC TV 18. Prashant this side. Did you see the BLS revisions out in the US overnight? And what do you make of it? Some 800,000 minus for the 12-month period ending March of 2024, which gets the monthly figure down to about 180,000 compared to 240 earlier. Is it a worrying signal? And what does it mean for Fed's policy response, if anything?
BLS, also the Bureau of Labor Statistics, as mentioned, revised down the last 12 months, the job figures report. But what we all know is the job market is not as strong as we believed it was, but it is still extremely strong. On average, you had about 175,000 jobs being created per month, and that's a very, very strong labor market still. It's weaker than we believed it was, but it is still very strong. What does it mean for the FOMC? I think it increases. It's not a game changer, but it increases the confidence for the Fed, for the FOMC to start cutting rates in September, to focus more on its growth mandate rather than its inflation mandate. So I think it increases the confidence to act, which I think is good news.
Jerome, hi, good morning. So the question is how much of action and how frequent? I think that's what the market's trying to understand, right? We were just looking at the probabilities in terms of whether it's a 50 basis points or 25 basis points. And I think the market believes it'll probably be 25. But what do you forecast ahead? Let's say over the next 6 months, will we get frequent small cuts? And will the Fed indeed achieve that soft landing that everyone is hoping for?
Well, we still have to see whether that soft landing will be achieved. I mean, as we know, soft landing are extremely rare events. So I will still be cautious on that. This being said, the economic environment is strong in the US. It's still solid, even with the weaker job market growth. Actually, what we know is we needed less jobs to create the 2.8% of growth that we had seen in the second quarter, which is actually not a bad thing. I think that means for the Fed, no reason to panic. We can go ahead in small steps. I would forecast the Fed to cut policy rates by 3 times this year, 25 basis points, and then follow through also in 2025.
All right. Hi, Jerome. Good morning and good to see you in. So 2025, how many rate cuts are you penciling in? And what does all this mean for an emerging market like India? You know, we've been outperformers. We have plenty going for us. But we seem to be ignoring any kind of bad news. Your take on the emerging markets, particularly the Indian markets?
Well, first of all, I think that the bad news is not what's happening on the macro front, but the bad news is what could be happening on the geopolitical front. There's a lot of tail risk on that front. There's a lot of uncertainty on the geopolitical risk front. On the Fed, I would be forecasting around 2 to 3 rate cuts this year and another 4 to 5 next year. Now, what does that mean for India? I think for India and for emerging markets, it's actually very good news that you have lower policy rates. Lower policy rates, it makes the financing conditions for hard currency debt much cheaper, and that helps emerging markets, and including India. And India is the fastest growing economy in the world. It's also the fastest growing insurance market in the world. And I think lower rates, which are going to come forward now in the US starting in September, I think that's also good news for India. And I think it also gives assurance to the central bank in India also to start cutting interest rates.
So India will be the pick among the emerging market basket?
I think India will continue to do very well. I have no question about that. The macro fundamentals are very strong. Portfolio flows are very strong. Maybe some sign of caution, which we need to look at, is the long carry trade unwind in Japan. If yen were to strengthen further, then India is exposed because India has been the biggest recipient of Japanese equity inflows. But other than that, fundamentals are very strong in India, and I expect that to continue. So.
All right, we leave it there. Thank you very much for joining us. Great speaking with you and appreciate you being here on CNBC TV 18.